With monthly rate hikes and a bear market, are bonds or GICs coming back into style? And can they be an important part of your portfolio? Holy banana bread, let's do this. When times were better and interest rates were low, both bonds and GICs really didn't provide very much of a return. Nonetheless, they still made up a good allocation of fixed income part of many investors' smart portfolios. Newer, mostly retail investors didn't pay too much attention to them as they were getting a bigger gain for their buck on the market or with cryptocurrency. A lot of financial advisor managed portfolios did have an allocation to fixed income, which included bonds and or GICs. Of course, retail investors have begun to realize just why financial advisors played it that way, as their portfolios managed the bear market a wee bit better than the retail ones. Before we sign up for a GIC, tell me in the comments if you have an allocation to fixed income in your portfolio. I am always grateful when you drop in on the home of free financial content on YouTube. While you are here, please subscribe as you don't want to miss a single moment, and a huge thank you for that click. When most people hear the word bond, they naturally think of James. The second thing they may think of if they are a Canadian is the Canada Savings Bond. This was an investment option provided by the Government of Canada from way back in 1945 to replace previous war and victory bonds. The Canada Savings Bond continued from then all the way up to 2017 when they were discontinued. There are still active Canadian saving bonds out there, but by 2027 they should have all been redeemed. There are other bond options from provincial bonds, corporate bonds, strip bonds, and then we have the GIC, the Guaranteed Income Certificate. Technically, a GIC is not a bond, but they do provide the same risk-free level of income with a guaranteed return. Overall, both GICs and bonds are very good ways to reduce overall portfolio risk while providing steady returns over time. Now, you may be wondering, which is better? Is it bonds or is it GICs? The big difference is that bonds are often more liquid and there can be some volatility if you decide to sell them before they come to maturity. When interest rates are rising, you can often lose some of your principal by selling a bond early. Of course, if you hold your bond to maturity, that is not an issue. Or if you sell when interest rates drop, you can also make a little bit of extra profit with bonds. With a GIC, you do not have the flexibility to sell it early. Also, you will be taxed on any income you make from your GIC if you do not hold it in a registered account. Most GIC providers also provide TFSAs and RRSPs, so they tend to be a pretty good marriage. GICs are also insured, so there is no risk, while a bond does not have that same level of insurance. And a corporate bond in a company that goes under can often become a very big loss. For long-term investors where the liquidity of bonds are not as attractive, GICs really do make a whole bunch of sense. Let's take a look at what my bank offers for GICs. I use EQ Bank, but I expect most banks will have similar GIC rates. With EQ, the minimum deposit is $100, though I think many of the big six require about $500 to begin. EQ does offer a whole bunch of them from 3-month, 6-month, 9-month, 1 year, 15-month, 2-year, 27-month, 3, 4, 5, 6, 7, 8, 9, and 10-year GICs. These can, of course, be registered or non-registered. They offer that TFSA or RRSP that you can put these into. And keep in mind, if you have a TFSA on Wealthsimple, you can also open a TFSA over on EQ or your regular bank to put a GIC in. Just remember that the amount you put in a TFSA where you've got your GIC will also add to the amount you have in your Wealthsimple. They both contribute towards your contribution cap. If we look at the interest rates, I have a chart for you. The 2-year or 27-month currently gives you the best rate at 5.10%. That is not too shabby. The 3-month gives you the lowest rate of 2.75%. Most of the long-term GICs are still close to 5%. Actually, they're 4.9%, which is not too shabby. These rates have been rising in our current environment, and that would be something I would consider before investing. If I were to lock into a 10-year now, I can get that 4.9%, but can I hold out for a better rate? We know that rate hikes will be ongoing for at least 6 months, so I would be very tempted to jump into a 6-month at 3.5%, then jump into a hopefully higher rate for my longer term investment. Maybe in 6 months, you can grab that 10-year at maybe 5.1%. No guarantee, but there is a good chance that that will happen. So, should you grab a 10-year GIC? If it is a long-term investment, it is a solid return and it would help you lock in your fixed income allotment. I would still leapfrog 6 months and take the chance for a better rate. If you are just looking for a solid return to ride out the bear market, then a shorter term would fit you even better. The 5.15% on a 2-year is not a bad rate at all. It is a safer bet that the bear market should hopefully be finished by then, maybe even in a year. The interest on your GICs can be paid out monthly, yearly, or at maturity, depending on your institution and the GIC length. Many institutions will also provide you the opportunity to compound it annually, then pay it all out to you at maturity. The other question is just how much allocation should fixed income get in my portfolio? Typically, it can range from 10 to 65% depending on how conservative your investment style. 10 to 20% is a good starting point for more aggressive investors, and then much more as you lower risk and move into a much more conservative portfolio. The fun does not have to end here. Check out my video on credit scores that I will link on the left. Otherwise, check out the video on the right that YouTube thinks you will like maybe a little bit more. Your click will decide who is right, and I will see you in the next video.